Okay, good morning, guys. Welcome to Friday, 11th of December, just past 8:30 as we get ready for the morning market briefing. I hope you're all well. Well done for surviving to the end of the week. Just before I start anything else, I want to talk about what's happening now in the markets, particularly in European equities. We had a low punched through on the Euro stocks at 32.51, just past 8 o'clock, so about 20 minutes ago. We've just tested that level again now, and a lot of the reports, a lot of the analysis coming out this morning is normally at this stage of December, well, not normally, but there is a theory of something called a Santa rally, which I'm sure you've heard of, which is in the final few weeks of the year, risk assets, including equities, are buoyed as we reach the Christmas break, but that's absolutely not the case at the moment. As an example, the FTSE currently is on a 7-day losing streak. Let me show you the FTSE. Let's have a look at the charts. That's QFA and CQG if you do have access to it. 7-day losing streak on the FTSE, which is the worst since August. That was the large sell-off in August that we had in the Chinese on the Shanghai Comp, 30% loss. So 7-day losing streak on the FTSE. 1, 2, 3, 4, 5, 6, 7. There's one green candle in there, perhaps not quite as dire as that headline suggests, but certainly on the FTSE here, we've got a very important level, the November low, 60.37. This absolutely doesn't look like a Santa risk move. Similar levels, if I just remove my pivot points, similar levels here seen on the DAX. You can see where we found support back on the 9th, so just a couple of days ago, 10.47, and we just found that low in November. So European equities playing a very similar pattern at the moment. Risk is off, sentiment is off, and all of this puts more and more pressure on Janet Yellen next week. Now, as you know, we're going to be running a late service next week for the FOMC. This really will be one of the events of the year. All of you guys in the house, of course, you're welcome to stay. We'll make an evening of it. But I know Bill and Piers have been talking to you about the Yellen put story shared by Anthony about JP Morgan talking about the billions of dollars in put options outstanding, currently out of the money. And if Yellen, this is on the S&P, by the way, these puts point the market, then the move lower, you will get a move lower in the S&P, of course, but this move lower could be exasperated by the fact that these put options might be back in the money and therefore executable. I would not want to be Yellen at the moment. This is not how perhaps she would like to approach her festive break, a more stressful situation I cannot imagine. Risk is off. Tension is high. The one thing that might help Yellen, of course, in her decision is the euro versus the USD, which we're seeing again today just approach those post-Draghi levels. So Bill's been talking about this level over the last few days. That's 1.10. 1.10. That level coming just above the pivot level now. Amplify strategy in the euro dollar on Wednesday. That worked at this level. Almost we got down to S1 before we powered higher, but 1.10 still relevant, and today's pivot level in the euro US dollar coming just below that. So this will be making her life slightly easier if she is to be raise rates, but certainly the equity market space causing a concern. And it is interesting to see just to what degree central bankers have been moved by what's going on in the equity market. So just to recap overall what's happened this morning and what's happened across different asset classes. Well, once again, of course, oil is one of our major stories. $36.69 trading in oil at the moment. This is the product that just won't bounce. Continued downside in oil as new Iran data comes out in the press this morning about just how far they are likely to increase production and how much the Saudis are not going to decrease their production unless other members of ex-OPEC countries do so. So it's a deal that can never be struck. However, having said that, you have seen quite a bounce in commodity shares in the overnight sessions at a micro level. You've got Chevron, ConocoPhillips, all of these have bounced. These commodity company valuations have bounced because of the release of their CapEx figures. Their capital expenditure has been dramatically cut back, making them more profitable entities, which of course helps in their bottom line. And in fact, if you look at Glencore price, for example, here we're looking at Glencore over the last 5 days, just trading up now just below the $90 handle. Given what's happened to the oil price, you might not have expected this type of move in a commodity product such as Glencore, but this is all about cost cutting at the moment and the moves that are being taken by these companies to help them survive. What does that mean for oil in the long term, however? Obviously, if all of these producers are cutting back on their capital expenditure, supply will be dented and supply will be affected. I think most people still believe that 2016 will see oil prices at these levels or higher. That's still the consensus at the moment, purely because of the fact that these low prices are cutting down investment in the industry, and therefore supply will have to be affected. The one thing, however, that these companies cannot control is the demand side. And if we move into an environment next year where you do have the Fed raising rates, where Draghi is being forced to be slightly more hawkish, where the Japanese economy and the Chinese economy are failing to recover, then the demand side angle might continue to push oil lower, even if the supply side starts to look more bullish. So moving on, just as a reminder, looking at the Asian session, the Chinese retail sales is going to be a big one, given everything that I've been talking about. Chinese retail sales will come over the weekend. I think that will create the sentiment power as we get started on next week. Volume has been light. Opportunity been kind of choppy, really, both this morning so far and yesterday. Certainly not favoring my style of trading. Here I've just had one trade so far this morning in the DAX. You can see it. I actually whisked out of this trade. We were just testing resistance. Can you see there at just underneath the handle of 1060 as we then push down below the pivot. But look, I guess the DAX is using this pivot quite well. I've just zoomed in on a 1-minute chart so you can see how the pivot's moving. But if you look out on a 15-minute chart, really, have a look at yesterday. This is trapped between the pivot and R1. No clear direction. Either way, no momentum there. So definitely for a my style, not something to look forward to at all. So anyway, Chinese retail sales, that's going to give us the sentiment for the weekend as we head into Yellen Wednesday, which is really what it's all going to be about. What are your expectations on Yellen? It is still very much for a hike, isn't it? It's got to happen. What's going to happen to the equity markets if she doesn't hike now, do you think? What's going to happen to the S&P? I can tell you, I think the S&P would sell off. I think you'd go back to what we saw in September when the market thought she was afraid to move and equities pushed lower. I actually think if she doesn't hike, there'll be chaos. I mean, the thing to trade is not equities, by the way, if she doesn't hike, just to make that very clear. If she doesn't hike, the thing to trade is the euro US dollar. If she doesn't hike, the thing to trade are T-notes. So just to reaffirm, because a hike is expected, if she doesn't hike, the dollar will weaken and the euro versus the US dollar will fly high. I mean, I don't know, 1.15. Quite in quick succession, pretty much. In equities, though, I think the picture will be a lot more complicated. If you go back to what the Fed did in September, do you remember? We were all expecting her to start to build in a hike for October or December. The market was very bullish on expectation of a hike. she pulled back, saying because of what was happening in the global economy, she could not hike, and the S&P had a disastrous week after that. Would the same happen again? Well, it's almost, no wonder there's so many puts on the S&P, because if you think about it, if she doesn't hike, in my opinion, the S&P is in trouble. If she does hike, I don't know if that's necessarily good news for the S&P either. So no wonder there's a lot of outstanding puts in the market. Kind of makes sense. But anyway, let's have a look at the data forward for today. Just coming up to 8:45, 9 o'clock, we've got Italian industrial production followed by UK data. So the pound versus the dollar has been certainly one of the assets to look out for. Really strong session back on Wednesday. Choppy session yesterday. The pivot level in cable working well. In these light volume markets, these pivot levels do tend to work well, but the pound's still looking relatively strong given its recent negative trend. We're just trying to buck that negative trend that we've had over the last few days. Just whilst that comes up, let's have a look at the data then. UK data, construction output, nothing really then till 1:30 where we get inflation data out of the US. Now, Yellen will be looking at this data, of course, so this will be good for the euro, US dollar. In fact, a plethora of US data coming out at 1:30, including retail sales month on month. US retail sales advance reading for November, retail sales excluding auto and gas, PPI final demand. Big data at 1:30, so don't be away from your desks at 1:30, given that it's Yellen next week. Given that it's Yellen next week, this is important, okay? Very weak PPI and very weak retail sales will make her decision harder. Assume she's going to hike. So now she's looking at reasons why she might not. Now you're trying to find out reasons that will just make it too difficult for her to do so. Then at 3 o'clock, we've got University of Michigan expectations. This is important. Important data at 3 o'clock, followed by business inventories. Heavy afternoon of US macro data. One thing to bear in mind, sometimes when you get this layup, when you've got the data coming out at 1:30, followed by significant data at 3 o'clock, the reaction to the data that you get at 1:30 can be muted, okay, as traders wait for confirmation of the 3 o'clock data. So do bear that in mind if you don't quite get the action that you're looking for at 1:30. And of course, right in the middle of that, we've got the cash market open. So interesting times indeed. Sentiment does seem to be bearish. Equity action so far this morning has been choppy. The push lower below the pivots in both the Euro Stoxx and the DAX, by the way, really was a derivative of the sneak higher in the euro as we got below that pivot. So bear that in mind. This negative correlation between what's happening in the euro versus the USD and European equities still exists. You can use that as a leading indicator. Just whilst we're on currencies, let's have a quick look. Looking at leading indicators of currencies, only 2 days ago, we were looking at the yen, when the yen provided us that great opportunity for equity short. So understanding how these products affect one another is, of course, of vital importance. So that's it, guys. That's it for my session. I'll speak to you in a moment.